Would you like
I
to start?
see that already 42 participants have already in the
Mm-hmm.
event also.
It looks like you're both in your offices as well.
Yeah,
We
I think we both are in our respective offices. Yes.
Oh, nice. Yeah, I'm still not allowed back on campus yet, but hopefully in the next month we'll be back not only on campus but also in the classroom in the fall. So I'm excited for that.
Yeah, we are not quite sure here. It's a bit iffy, but hopefully this fall we could start as well. I don't know.
Yeah, fingers crossed. Hopefully conditions keep improving.
Hmm. Inshallah, as we said.
So, should we start, Prashant?
Yes, please.
Okay. Good evening to all of you. On behalf of the Mishra Center for Financial Markets and Economy, IIMA, I welcome you all to this webinar. In particular, I welcome Dr. Patrick Smith, San Diego State University, to the center of IIMA. This center is kind of a new center at the institute. Just to give you a brief, I think this center undertakes practical and kind of executable research on financial markets and economy that addresses issues relating to formulation of policy, market structure, regulations, including central banks' mandate, monetary policy, fiscal development, real estate, microstructure, including commodities, banking, bond markets, SME financing, I think financial inclusion, maybe a broad gamut of things, what happens in economy and finance. So, and we also facilitate a wider scope for research by faculty and doctoral students or researchers around the world. Particularly, we look forward to collaborations, and we also engage ourselves with relevant stakeholders who influence policies, at the same time those who are affected by those policies. So I think that's the brief on the center. With this, I think small introduction on the center, I hand it over to Prashant to take it over for the webinar today. Over to you, Prashant.
Thank you very much, Abhiman. And good evening, ladies and gentlemen. I'm your host for today. My name is Prashant Das. I'm an associate professor of real estate in the finance and accounting area here, and also a member of the Mishra Center. We have a very nice group of attendees today in this webinar. I see our friends from all the way from Tokyo to Texas, and of course from different parts of India. Um, Today's paper brings machine learning based textual analysis of a huge data set into agency theory, addressing defaults in mortgage loans. The issue of non-performing assets of lending institutions came to the forefront in India when Raghuram Rajan took charge of the Reserve Bank, who also serves on our board of advisors. These issues were, however, mostly in the context of lending to businesses and big ticket promoters. But loans issued to households also deserve specific attention. After a mortgage loan is issued, the lender will either securitize the loan into mortgage-backed securities or keep the loan on its own balance sheet, named as portfolio loans. In the US, when a mortgage lender is faced with a loan default, she has a few choices to deal with the situation. For example, she may allow for a short sale, as Patrick will be using in this paper, wherein the borrower is given some time to sell the collateral himself. Another mechanism is called REO, real estate owned, wherein the lender forecloses on the asset and keeps it on her own balance sheet, perhaps to be disposed of later. In both cases, the lenders are expected to face some degree of loss severity, as the asset will likely be sold at a heavily discounted price. Which path would the lender take is what today's paper attempts to explain. The paper explains the lender's decision in light of mortgage securitization process, because not all mortgages will be securitized. And agency conflicts between loan services and investors will be at the forefront of the discussion in today's paper. So with that, I welcome Dr. Patrick Smith. Today's presenter, Dr. Patrick Smith, talks from San Diego State University. As you can see, it's early morning at his place. Patrick has his papers published in such journals as the American Economic Review, Review of Financial Studies, Journal of Real Estate Finance and Economics, Real Estate Economics, and Journal of Real Estate Research, among several others. Dr. Smith is an associate professor of finance, and earlier he was a visiting professor at the Pennsylvania State University. He received his PhD from Georgia State University in Atlanta. And before graduate school, he worked for nearly a decade in corporate finance and business analytics. He will be presenting his paper titled The Effect of Mortgage Securitization on Asset Liquidation Decisions today. So Patrick, the floor is yours. Please go ahead.
Thank you, Prashant. So I'll share my screen to show my slides here. And thank you everyone for joining. I know, you might be able to see the sun kind of coming up here. I'm sure the sun is setting for a lot of the participants here. So I really do appreciate you, joining this late in the evening and making time in your schedule to give feedback on this paper, because this truly is a work in progress paper. We haven't really circulated a draft yet because we're trying to get feedback, and we're going to take all that feedback and all the comments and insight that we get today and actually put it into the next version. And then we plan on posting it and start circulating the paper a little bit more. So
sorry to interject, Patrick.
Sure.
Just some housekeeping. We encourage all the participants to interact with the speaker. But in the interest of time, I request that if you have any questions or suggestions, please post it in the chat box, and I will try to pose it to the presenter in due course of time. Thank you very much.
Yeah, perfect. Yeah, I would, piggybacking off that, Prashant, as much feedback and questions as we can get. I'd like to make this as interactive as possible. So if you do have questions, or if I talk about a topic and you'd like a little more clarification or insight into that topic, please do post in the chat box or in the Q&A section. And I'll try and pause every once in a while, or ask Prashant to jump in and ask those questions to me. So this is early stage work. It's work with a colleague of mine at SDSU, San Diego State University, Anurag Mehrotra, and also with my frequent collaborator, Adam Nowak at West Virginia University. So I'm going to do something a little bit different here in terms of how I do my presentation. And I'm going to actually go back and talk about what was the motivation for this paper. So when I see a paper, and sometimes I read a paper and I say, wow, that's a really neat idea, or that's an interesting way to look at this topic or this question. So I always, whenever I talk to an author, I always say, how did you come up with the idea? What was that light bulb moment that made you think of that? So I'm going to start off the presentation by actually talking about the motivation for this paper and what actually inspired us to look at this question. And then once I kind of go through the motivation, then I'll launch into a more formal presentation. So the motivation for the paper, this actually goes back to when I moved to Atlanta in 2011. And I moved to Atlanta, as Professor Das, Prashant mentioned, to start my PhD studies after working for approximately 10 years in corporate finance. So I moved to Atlanta in August 2011. And, when you start your PhD, it's going to take approximately 4 to 5 years. So I figured I'm going to live in Atlanta for, 48 to 60 months at least. And if I'm living there, I'm going to have to pay rent for 48 months or 60 months, depending on how long it takes me. So I did a quick back of the envelope calculation. Rents were about, we'll say about $1,000 a month. So I knew it would cost me in rent about $48,000 to $60,000. Now, in the US in 2011, we were still in a housing crisis. So I knew that I could either rent and, pay 48,000 to 60,000, or I could try and buy a condo for, approximately the same price. So I did a little research online and I found a condo that was relatively new. And Prashant actually knows the condo. We spent some good times there together, and all my PhD colleagues. But I found the condo online listed for $40,000. And uh, I knew that it was an REO. So Prashant alluded to this. An REO, or a real estate owned condo, means that the previous borrower defaulted on the mortgage. And then it became real estate owned, which means that the bank or the lender now owns that condo. So it wasn't a traditional arm's length transaction where I was buying it from the previous homeowner. The previous homeowner had defaulted and it was now transferred to the bank who is now selling that. So I figured that I had some bargaining power here. So I decided to go in with an all cash offer of 34,000. So I was kind of doing a little bit of a low ball offer here and hoping to settle somewhere in the middle between $40,000 and $34,000. So I was hoping to get the condo for about $37,000. So I made the all cash offer. And then the seller, after a couple of weeks, they came back and they countered by reducing the price by $100, but they actually added on an additional fee of $199. And I'd never heard of this web and technology fee. So for whatever reason, this kind of rubbed me the wrong way, because not only did they not come down in terms of negotiating, but the price actually went up by $99. So I kind of stewed on it for a couple of days, and I decided, well, if they're not going to lower their price, I'm not going to come back and increase my price. So I called up my agent and I said, I want to reduce my offer by $199, and then I'll add on the fee, and the total will be $34,000. And my real estate agent said, he thought I was basically wasting his time. That if I countered here, there's no middle ground, and he wanted me to increase a little bit and try and meet in the middle. So for whatever reason, though, that web and technology fee, that just kind of, on a principles basis, it kind of bothered me that they were adding this in after the fact. So I said, well, let's just make the offer and see how it goes. So we made the offer. The agent, he told me probably not going to happen. We'll see what they say. Maybe they'll reduce their price. So we made the offer, and then about a week later, much to our surprise, the seller accepted that offer. So I had initially offered 34,000. I actually reduced my offer, and they accepted that lower offer, after the second bid. So at the time, I thought I was, a master negotiator, right? Like, I called up my dad, I called up my parents, and I said, you'll never believe what happened, right? I actually reduced my offer, and then they accepted it. So I thought I was really smart. But this was before I did my PhD studies, and I kind of learned about what was going on in the real estate market. So looking back on that, a couple of years later, when I was doing my PhD studies, I kind of, started learning about bargaining power and clientele effects and mortgage securitization. So what I did is I went back and I looked at my deed, and I found that, I knew it was REO bank owned, but I found out that the house wasn't actually owned by a bank. So here's the actual deed for the transaction, and we can see that the property was owned by a trustee for a private label securitization. So I'll talk about what a private label securitization is a little bit more later in the slides, but this basically tells us that it wasn't the bank that I was negotiating with. I was negotiating with a servicer that was negotiating on behalf of investors for the private label securitization. So when Professor Das was alluding to these agency conflicts, the agency issues, this is, kind of a anecdotal, right? The sample size of one example where, I thought I was negotiating with a bank, but I was actually negotiating with a servicer, and that servicer did not have any credit risk. They had no claims to the cash flows. So if they got a higher price, they received no benefit, right? If they had negotiated 37 instead of 34, they would have still gotten the same fee for that negotiation. So this was kind of the light bulb moment for me when I went back and looked at the deed and I said, wow, this is pretty interesting. I think securitization affected the negotiation, right? Initially, I thought I was this really good negotiator, but then after going back and looking at the deed, I kind of thought, well, maybe that's not what's going on. Of course, this is only a sample size of one. So I said, okay, we have to go back and look at this, but across the United States, we have to build a large sample and actually test this formally. So that was kind of the motivation for this study. Now, you may ask, okay, well, securitization, it's kind of unique to the U.S. So let me give you a little insight into how frequently a mortgage is securitized. And Prashant kind of alluded to it, but typically when you take out a mortgage in the United States, you can go to Bank of America, you can go to Wells Fargo, some of the biggest banks, they're going to make a loan to you, but then they're going to take that loan and sell it to either, we can see here in the slides, either a GSE securitization. So GSE, that means government sponsored enterprise securitization. So you may have heard of Fannie Mae or Freddie Mac. They're two very large government sponsored enterprises. Now they're in conservatorship. So they're actually kind of overseen by the government. So we can see that, a large fraction of the loans in the United States are securitized into GSE pools. So that means Bank of America may give me the loan, but then they sell it to Fannie Mae or Freddie Mac. Fannie Mae or Freddie Mac buy thousands of loans, they pool them together, and then they sell them to investors. So the eventual claimant, residual claimant on the cash flows from my mortgage are going to be investors. And then there's a servicer that then negotiates on their behalf with, assuming there's a default or anything that basically collects cash flows and negotiates for them. So GSEs could be a possible securitization. FHA and VA, they're pretty similar to GSE, so I'm going to skip over them. But then there's also PLS securitization, and that's one of the primary focuses of this paper. And we can see that PLS securitization, we see that there's a rapid rise in terms of market size, in terms of the number of loans that were securitized into these private label securitizations. So if we could jump to the next slide, this will just kind of show it in terms of the percentage or the share. So this is showing that, in the 90s, if we were to project this backwards about 10 years, we'd see that PLS securitization is very similar to how it is now. It's very small market share, but during the 2000s, they started to take up, 10, 20% of the market. And these PLS securitizations, they're representing, they're basically hiring a servicer to look out for the interests of the investors here. So we can see that over time, securitization in the United States, the majority of loans that are originated are going to be sold onto the secondary mortgage market. So the biggest player over time is definitely the GSEs, Fannie Mae, Freddie Mac, and then we have FHA and VA. We'll say that's primarily Ginnie Mae as well, so another government entity. And then during the 2000s, there was also a lot of private label securitization where you didn't have Fannie Mae or Freddie Mac buying them. You had large financial institutions buying them, pooling them, and then selling them onto investors. So we can see that securitization in the United States is, it's the new model, right? Originate to distribute. Banks lend, then they take that loan, they sell it. When they sell it, they make some fees, they get their cash back, and then they can keep lending. So it provides a lot of liquidity to the market. So there are some benefits, but what the idea of this paper is to show that, yes, there's benefits, but there's also some potential issues with that. There's some agency costs associated once you have a lender making loan decisions and then no longer having a financial stake in the loan. So that's what we're going to look at. And I'll come back to this slide in a second. So the background on this, so I kind of talked about the motivation. I talked about the background of securitization in the United States. And I'm going to do a really quick high-level literature review. I'm not going to spend too much time talking about the literature, but I just want to also place this paper within the literature. So we said that over 70% of mortgages are securitized, and there has been some research on the effect of securitization on loan modifications. So I jumped over the last slide. Let me return just to talk about loan modifications. So our study is going to look at asset liquidation decisions, but previous studies have looked at loan modifications. So what happens if a bank makes a loan and the borrower stops making payments, then they're delinquent, right? So the black line here is kind of tracking loans that are 90 or more days delinquent, right? So in the US, we consider if you miss 3 payments, then you're delinquent on your loan, right? So we can see that during the 2000s, it was below 2000 or 2%, and then it started shooting up during the housing crisis, starting in about 2007. And then once you're delinquent, the bank has some options. They can offer you a loan modification. So they can offer to reduce your interest rate, reduce your monthly payment, do some principal forgiveness, or basically write down how much you owe. Or what's going on now in the United States, we can see that delinquency rates have gone up, but the foreclosure rate has gone down. So there's been a lot of forbearance that's been going on in the United States, where if you miss payments, they'll just take those payments and kind of add them on at the end of the mortgage. So there's a lot of different options that lenders or servicers have once you go delinquent. They can modify the loan. That way it makes you more likely to stay in the house and continue making payments. Or the second option that they have is that they can foreclose on the loan. So if you're 90 days delinquent, they can modify it, or they can actually foreclose on you, right? So foreclosure means that they're going to, if you're in, depending on which state you're in, they can either, if you're in a judicial state in the United States, then they have to take you to court and foreclose on you. They have to get a court ruling that, you're delinquent and you're no longer the owner of the house. In non-judicial states, they don't have to go through the court proceedings. They can just foreclose on you after a certain length of time. So we can see that the two lines together, the add up, or the two, delinquency plus foreclosures add up to give us this blue line here. And we can see that, no surprise here. I don't think this is news to anyone, but there's a very big housing crisis in the United States. And not only did delinquencies jump up, but we also had foreclosures as well. So a foreclosure will happen when no loan modification happens, right? The bank decides we don't want to modify the loan, we just want to foreclose. So the literature is focusing on loan modification rates, right? And they show that if you have a securitized loan, that it's going to decrease the likelihood of modification and increase the likelihood of foreclosures. And during the housing crisis, everyone was worried about foreclosures and REOs and this cascading wave of defaults of homeowners. So the literature is focusing on loan modifications, right? The 3 studies here, Piskorsky et al., Agarwal et al., and Kruger et al., they're all in Journal of Financial Economics, really great publications that show that securitization does affect modification rates. However, there's also studies that show that only 10% of loans are modified. And the 10% that are modified, 50% redefault. So what does that mean? That means that of all of those delinquencies that we saw, only 5% are modified and stay reperforming. That means 95% of those delinquencies are going to be liquidated, right? So the studies, previous studies focusing on loan modification rates are definitely important, and they provide important insight. But that's only really, 5 to 10% of the market. 90 to 95% of the loans are being liquidated. So we're basically asking, what is the effect of securitization on how the loan is liquidated? So The literature is focusing on loan modification, and we're basically saying, yeah, that's important, but that's a small fraction of the loans. 90 to 95% of them are going to be liquidated. So we also have to look at this angle as well. I'm going to pause for a second because I saw, I think, a couple of questions or hands being raised.
CK Arafat from Bangladesh, he works in the industry. He is asking, why should there be any tolerance to delinquencies?
That's a good question. So in terms of tolerance turn, so that would be more on, I think that's asking more, why would you modify a loan, right? Why would you reduce someone's payment or reduce their, their principal balance? And that's a good question. During regular times, if we're in a healthy economy and house prices are rising, then loan modification probably doesn't happen as much, right? Because the bank knows if they take ownership of the property, they can then sell it and get back they can take ownership of the collateral and basically sell it and get all of their money back. However, during the housing crisis, because house prices were declining so fast, and not only were they declining so fast, there was a worry that if we had more defaults, it was just going to start a cascading wave, right? Like during times of fire sale, we had a lot of defaults, and there was worry that if each default was going to set off another default. So we're trying to stem this cascading wave of defaults. And the idea here is some of these homeowners, they can afford to make the payments. And if we can keep them in their house, then they won't default, which means that their neighbor will not default. So the idea there was, and there was also a thought that we could modify these loans down, right? We could reduce the principal balance, but if the principal balance is still higher than the liquidation price, then the bank is still better off. So there was a lot of internal calculations going on. So it was one, trying to stop this cascading wave, and two, it was also a financial decision on the bank, the lender, the servicer's part, trying to calculate, is the net proceeds from this modification equal to or above what we would get liquidating the property? Because once you have to liquidate the property, there's a lot of expenses and costs associated with that. The bank isn't really in a real estate business, so they don't want to take ownership of the property, because then they have to pay for a property manager, they have to pay insurance, taxes, all of these additional costs associated with it. So sometimes reducing a balance or make a concession to the delinquent borrower is actually a wise financial decision. Now, this wasn't built into the question, but in the back of the mind, a lot of listeners are probably thinking, well, could this have some perverse effect where, once you start making concession, then everyone is going to ask for that concession, right? There's some type of moral hazard there. And that's definitely a concern as well. If you hear that your neighbor, got their balance reduced by, $10,000, $20,000, then maybe you'll stop making payments so you get the same concession. So,
and that's what you show in your paper as well, right? We do have some other comments as well. Thank you, Aditya and Devarpita. I guess we should move on with the research presentation, and then towards the end, we will address these questions as well.
Okay, sounds good. Yeah, and what time do I have until, Prashant?
You have around 40 minutes.
40 minutes? Oh, okay.
Yes.
Plenty of time. Mm-hmm. Yeah, but that was a great question in terms of.
And if I could add, with your permission, Dr. Smith, that healthy loans are in everyone's interest. The lender doesn't want you to default because they want a constant long-term stream of interest payments. The government policies also, because it becomes a social problem. If too many delinquencies happen, too many people will have to be evicted. So it's also a matter of political desire to stop these delinquencies. And as Aditya rightly points out, that delinquencies can be very expensive. Dr. Smith, because I've seen your paper, there is a lot to be discussed. So I was hoping that we could continue with the presentation. Yeah.
Definitely, yeah. So I think we have the motivation set up, we have the background, we placed it a little bit in the literature. So, you know, I'll get into actually what we do in the paper. Hopefully you have a, you know, a good bird's eye view of what we're gonna try and test here. So you probably saw the title of the paper. We're going to study the effect of mortgage securitization on servicers' asset liquidation decisions. So what does that mean? Well, in terms of asset liquidation decisions, we're going to look at the liquidation channel. So when a loan goes delinquent and there's no modification, which means we have to liquidate the property, the bank or the servicer has a couple of options. Well, they have a few options. We're going to focus on two of them because the third option is it's just not very frequent in the data. It very rarely happens. So we're going to focus on two channels of liquidation. The bank can either do a short sale. The bank or the servicer can do a short sale with the borrower, or they can do a REO transaction. So the primary difference here is that with a short sale, the bank does not foreclose on the borrower. So they're basically allowing the borrower to sell the house for less than what's owed. So let's say I'm a borrower, I've stopped making payments, I owe the bank $200,000 for my house, but the value is only $100,000, right? If I want to sell that house, I'm going to have to sell it and then also pay the bank $100,000. Most borrowers in the United States do not have $100,000 just sitting around that they can then give to the bank to perform that transaction. So what the short sale does is the bank gives permission to the borrower to sell it for less than what's owed on the mortgage balance, right? So I owe 200,000, the market value is only 100,000. The bank says, you know, get an appraisal. If it's $100,000, you get an offer, then you can sell it. And the bank is basically approving that transaction. That way they don't have to take ownership of the property. They don't have to incur all of those expenses. So with a short sale, the bank does not take ownership and the borrower can stay in the house until it's sold. Now, REO is slightly different. With an REO, the bank, you know, maybe the short sale is unsuccessful or for whatever reason, they don't want to do a short sale, but the bank basically goes through the foreclosure process. They take ownership of the house and the borrower is removed. Either they move out willingly or they're evicted from the property after the foreclosure. That way, you know, we can kind of see it in the name of the liquidation, right? Real estate owned. That means that it's bank owned or lender owned. And then once they own the property, then they can sell it through, you know, through the MLS or multiple listing service or, you know, on any website here in the United States. So the servicer or the bank, if it's a portfolio loan, they have two options here: short sale versus REO. We're going to look at, does securitization affect how the property is liquidated? And then the second thing we're going to look at is the liquidation price. And this kind of goes back to, you know, my example with my condo in Atlanta. I have a ex ante. I think that if the loan is securitized, that especially if it's a PLS securitization, the servicer for the PLS loan is going to have less motivation to negotiate a higher price because they have no credit risk. They have no residual claim on the cash flows, right? If they had negotiated $37,000, they wouldn't have gotten to keep any of that with my condo. So they accepted the $34,000 because it didn't hurt them. However, it does hurt the MBS investors, right? The investors that the servicer is representing. So we're going to look at how the property is liquidated, short sale versus REO, and then conditioning on how it's liquidated. Do the prices differ whether it's a portfolio loan? So portfolio loan means that the bank originated the loan, let's say Bank of America, Wells Fargo, and then they kept it on their books. We expect those liquidation prices to be higher than if the bank originated the loan and then sold it on the secondary mortgage market. And there's a servicer doing the negotiation because, again, they don't have the same incentives as the bank does. So we're going to look at those two channels. So you may ask, why do these liquidation decisions matter? So this kind of goes back to what we were talking earlier, in that not only does it affect the bank itself, but it's going to in fact affect the investors and then also the neighbors living in those areas, especially during a time of crisis. So there's been research that shows that short sales have benefits to lenders, investors, and neighborhoods. So short sales sell for a premium relative to REOs. So when we're looking at the liquidation channel, I would argue that if I'm the bank, I will always benefit from doing a short sale because they sell for a higher premium than an REO. So if I'm a bank or I'm an investor, I want my servicer to always attempt to do a short sale. Why? Because they sell for a higher price. Now, not only do they sell for a higher price, so you would think banks, servicers would want to do a short sale, but because they sell for a higher price, the spillover effects also benefit the surrounding homeowners. So we're basically going to argue in this paper, if there had been more short sales instead of REOs, then it would have dampened the cascading wave of defaults, right? If my neighbor did a short sale, it's going to have a smaller impact on my house price. I'm less likely to default. However, if they do an REO, that's going to have a much, a bigger negative effect on my house price. That's going to reduce my equity. And if I'm underwater, I might be more likely to default. So we're gonna have an empirical setting where we can actually test, do the type of liquidation affect the subsequent default in the neighborhood itself. And that's kind of the mechanism that we're going to use. We're going to look at short sale versus REO, and then we're going to show that it's the price associated with those two liquidation types that then spills over and affects subsequent default in the neighborhood. And the idea here from a policy perspective is that if we had more short sales during the late 2000s, during the housing crisis, then it might have dampened this cascading wave of defaults, right? Maybe the housing crisis wouldn't have been as as big and as prolonged as it was. So there's some policy implications here that I think are fairly important. And the takeaway here is, if we do find that short sales reduce subsequent default, then we should provide incentives to have banks, to have lenders perform these short sales. And there was some policies that tried to do that during the housing crisis. Now, we see that short sales benefit lenders, investors, and neighborhoods, but the benefits for borrowers are a little bit less clear. So if I'm a borrower and I'm delinquent, then a short sale is good for me because I don't go through foreclosure, right? The bank never forecloses on me, so it has a smaller impact on my credit score. So if I want to buy a house again in a few years, if I have a short sale, that'll help me qualify for a mortgage in the future. Now, an REO could also have some benefits. So depending on which state I live in, if I live in a judicial state, I mentioned this earlier in passing, if I live in a judicial state, the lender or the servicer has to take me to court. And during the housing crisis, there was a backlog of court proceedings. So it could take up to 2 years to actually take me to court and foreclose on me. So if I'm a borrower and I live in a judicial state, then an REO actually might provide me free rent for 2 years, right? I'm not making mortgage payments, but I can live in the house until I'm foreclosed on. So I might prefer an REO. So even though short sales have benefits for lenders, investors, and neighborhoods, the benefits for the borrower are a little less clear. So depending on where I live, I might prefer a short sale versus an REO. And what we do in this paper is we're going to include cities. We're going to use data from both judicial and non-judicial states just to show that the effect that we find does generalize to both judicial and non-judicial in the United States. However, the primary focus on this paper is to look at agency issues introduced by securitization. So I'm going to show 2 quotes here that basically highlight the incentives of servicers. So again, most servicers, they don't have credit risk. They don't have a residual claim on these cash flows. Servicers are representing the investors, right? Servicers collect the principal and interest payment from the mortgage borrower. They then pass them on to the investors and they get a fee for doing this. So the servicers, their primary source of revenue is fees. So if we were to think about asset liquidations, we're going to see that there's some agency issues associated with these liquidations. If we have a short sale, right, conditioning on a house having to be liquidated, if the servicer does a short sale, well, the borrower is still living in the house. The borrower's, facilitating the transaction. So the opportunity to charge fees for the servicer are minimized, right? So the servicer, if we were to look at financial incentives, they don't have much of an incentive to try and do a short sale. However, if we look at REOs, within REO, the servicer has to foreclose on the property. Then they take ownership of the property. They have to manage the property. They have to, mow the lawn, do inspections. They have to list it. They have to show it. They have to, basically take ownership of that. And what they can do there is start to charge fees. And we said that the primary source of revenue for these servicers are fees. So I have two quotes here that kind of highlight some of the perverse incentives of servicers. And these are both from Countrywide Financial, which is was a very large, I think they were close to going bankrupt and they got bought out by one of the large financial companies. But this kind of highlights this perverse fee structure. So the first quote here is from the president of Countrywide Financial that says that, even though there's a housing crisis, they have an opportunity to generate fee income from late charges and, importantly, from in-sourced vendor functions.
Dr. Smith, we have some pertinent questions. Professor Ram, we will try to take your question up later. I'm currently focusing on questions related to the research method. Sunil Khandelwal is asking, does it involve any transactional cost in case bank took REO route, as it may lead to higher operational cost at both transfer points? And
Yeah, no, that's perfect question. I think if I were to plant a question in the audience, that would be the question that I planted, because that's going to set me up. That's, what I was trying to get at. And that's good. It's going to focus me here, because that's exactly right. So in terms of the additional fees associated with the REO, the servicer is collecting those fees, and those additional fees are getting taken away. They're basically reducing the net proceeds to the investors, right? So if we were to think about agency issues here, the servicer prefers REOs because they can charge all these fees. However, these additional fees come out of the principal and interest or the mortgage balance. Once the property is sold, the liquidation price, these fees are getting subtracted, and then the remaining amount is then getting passed on to the investors. So the investors, they want a short sale. One, because they get a higher price, and two, because there's less expenses that are associated with it. However, the servicer, they want those fees. That's how they make money, right? So the quote here is saying they're going to collect late charges and they're going to insource some vendor functions. And not only are they going to insource some of these vendor functions, but they're going to mark up the price of these vendor functions by as much as 100%, right? So Countrywide created subsidiaries, and then when they had to do property inspection, they hired their subsidiary, who then hired a vendor, and they doubled the price. Now, that's good for the servicer, but that subtracts the net proceeds that go to the investor. So in terms of short sale versus REO, it's not only the case that short sales get a higher price for the investors, but also it reduces the expenses associated with the liquidation. So the net proceeds for a short sale are much higher than an REO. And this kind of gets at that principal agent conflict, right? Servicer who's representing the investor wants an REO. However, the investor who's being represented by the servicer wants a short sale. So there's a misalignment of incentives between the servicer and the investor. And that's what we're going to try and show in our paper, is that if we have securitization, it's going to reduce the likelihood of a short sale, because that's the servicers are making the decisions and they don't want a short sale because it doesn't give them this opportunity to, charge these additional fees. All right. So let me preview the results here just to, I'm going to jump into individual questions, but I want to give a preview early on just so you kind of know what we find as I raise these questions. So the first thing we're going to do is ask, what are the effects of securitization on the asset liquidation decisions and nearby defaults, right? So I said we want to know, does securitization affect whether it's a short sale or an REO? And we find that conditioning on default, securitization is a strong predictor, and we'll see that in a couple slides, of dated versus via a short sale or an REO. And securitization, if we have securitization, we're going to see that if a loan is securitized, much more likely, I think it's 20 to 30% more likely to be liquidated via an REO. And if we jump back, why do servicers want to do an REO? Again, this is where they can charge these additional fees. So this is what we expected to find. And we were pretty surprised when we saw the magnitude, how strong this relationship was. So we find that securitization increases the likelihood of an REO. And then we ask, okay, that's an interesting finding, but does that have any real effects on the economy? Should we be worried about this finding? And we set this up and we basically say, well, again, going back to the price effect, we know that REOs sell for a deeper discount, a steeper discount than short sales. So we ask, well, if I live next to a house that's being liquidated, does that affect my default decision if it's an REO, right? Because it's going to be a bigger negative price shock or negative externality. Does that increase my likelihood that I will default or that surrounding homeowners will default? And what we do is we basically create these neighborhood clusters centered around asset liquidations. We basically say, if you live within a 1/10 of a mile of a house being liquidated, does how it's liquidated affect the subsequent default in the neighborhood? And we use a setting here that's very similar to, there's a great paper in Journal of Finance 2019 by Arpit Gupta that basically uses a very similar framework. His setting and question are completely different, but the framework that we use is very similar. So we basically show that if we look at the initial default in a neighborhood, right? The first default, because if there's multiple defaults, there's a lot of confounding factors and we want to eliminate those. So we say the initial default in one of these neighborhood clusters with a 1/10 of a mile radius, if it's sold as an REO, it's going to increase the likelihood or the probability of nearby default by 3 percentage points. And that's on top of a base probability of about 4 percentage points. So the effect here is fairly large based on, on that base probability. So we see that, this suggests that if we had more short sales during the real estate crisis, that it might have stemmed the flow of default in the surrounding neighborhoods.
So Professor Arpit Gupta from NYU will be one of our upcoming webinar presenters as well, just a trivia.
Oh, definitely send me the invite. I would love to see his presentation.
Sure.
Yeah, he has some great papers. So that was an excellent choice. Yeah. Okay, so we're gonna so that kind of previews the one setting here. Then we're gonna also look at that's getting at the liquidation channel, right? We said we have two decisions: the channel through which it's liquidated, and then also the liquidation price. So when we look at the liquidation price, we're going to do something interesting here, something that hasn't been done in the literature. The literature shows that REOs sell for a bigger discount relative to short sales. That's kind of common knowledge, right? Short sales sell for a premium relative to REOs. But what hasn't been looked at is if we interact short sale or REO with the seller type, whether it's portfolio, GSE, or PLS, does that have an impact on the liquidation price itself? And we find that it definitely has an impact. We find that REOs, so bank held properties held by the GSEs, Fannie Mae, Freddie Mac, they sell for a 6.7% premium relative to PLS REOs, so private label securitizations. And you may ask, that's a big number. Anytime I see an effect that big, I always say, well, that doesn't seem reasonable, right? Like, why doesn't, if PLS can get a 6.7% premium, why don't they negotiate a little bit more? And I think that's a fair criticism. So what we do is we actually adjust for the condition and quality of the property, because what we're doing right now is we've downloaded some data from Fannie Mae and Freddie Mac. And what we found out is that Fannie Mae and Freddie Mac, because they're under conservatorship by the government, and they have some ties, they have the government backdrop, they have some obligations in terms of the type of properties that they sell. So we find that they actually do a considerable amount of capital expenditures, or CapEx, before they sell the property. So they're doing property improvements before they liquidate the REOs. So we realized that we have to control for the condition of the quality of the property, right? And I'll talk about this a little bit more later in the slides, but we're going to use text analysis. And my co-author, Adam Nowak, and I, we have a couple papers that use text analysis to control for condition and quality. And we're going to do that here because we're worried that the GSEs are doing CapEx, but PLS, the servicers there, they're not doing it, right? Because they don't have the same incentives. One thing to note about the GSE REOs, when the GSE sells the property, they have credit risk. So every dollar lost, the GSE, the Fannie Mae or Freddie Mac, every dollar lost, that comes off their balance sheet. Whereas with PLS REOs, every dollar lost is a dollar lost for the investors. So GSE REOs, they have an incentive to maximize the sales price. In essence, GSEs are very similar to portfolio lenders. So, if Bank of America originates a loan and keeps it on their book, they're going to sell it. They have similar incentives to the GSEs because they have that credit risk. PLS REOs, the servicers making decisions there, they have zero credit risk. Every dollar lost is a dollar lost by the investors, not by the servicers themselves. So we're going to adjust the condition and quality, and we're able to reduce the premium between GSE and PLS to about 3.8%, which I think is a little bit more reasonable. It's not, we don't make the claim that we're controlling for condition and quality perfectly, because we just don't have all the information, but we're able to reduce that magnitude considerably here. And we explain that 3.8% difference based on GSEs have credit risk, so they're going to negotiate for every last dollar, whereas the PLS REOs, they don't have credit risk, right? They're negotiating for the investors, but at the end of the day, they're going to get paid no matter what, right? They're not losing anything. And this kind of ties back, if you think to the beginning of the presentation, I bought my condo from a servicer negotiating on behalf of a private label securitization. So, that's kind of why I led with that, to hopefully provide some anecdotal evidence to back up this finding here.
Dr. Smith, if I may,
sure.
if you could quickly rush us through the methodology, because we have 10 minutes left and there are a lot of questions. Some of them are very good questions.
Oh, wow.
We would
I'm
like
sorry.
to spend some time on, a lot of these questions are about the fundamental structure of mortgage securitization in the US.
Okay. Yeah, great. Yeah, I can jump through. I can do the quick version in 10 minutes. So in terms of the data itself, I'll just briefly talk about this. So we have 3 data sources. I think one of the contributions of this paper is just the amount of data work that went into this paper. We're going to have MLS data, multiple listing service. Anytime you want to sell a property in the US, typically you list it on an MLS, multiple listing service. And this data is important because it's going to tell us whether it was a short sale or REO listing, and it also gives us the agent remarks. And we're going to use those agent remarks or the description about the property to control for the condition and quality. We're going to then merge the MLS data with the a database called ZTrax. This is basically a Zillow database that they provide to academics for free. Really nice service that it's basically tax and deed, tax assessor records, very similar to the deed that I showed earlier in the slide. So I could go into the ZTrax data in Atlanta and I'd be able to see my deed. I could see who sold that property and I could identify, was it PLS? Was it Fannie Mae or Freddie Mac, GSE, or was it a portfolio loan, right? Bank of America lent it and then they kept it on their books. And then in some cases, there is some ambiguous seller names because Bank of America, not only do they keep some loans on their book, but they also service some loans. So we're not necessarily sure if they're selling it for themselves as a portfolio loan or if they're servicing it and selling it there. So we use the HMDA data as a backup to identify whether it's been securitized or not. So we have about 1.75 million transactions. We're focusing on the housing crisis. And again, alluding back to a couple points I made earlier, we're looking at non-judicial and judicial states because there is some difference in terms of the foreclosure laws. So just give you kind of an idea what one of the cities looks like here in terms of these distressed sales transactions. This highlights, not only the short sale listings, but the amount that are sold. So we can see that over time, the number of distressed transactions, both short sale and REO, increased rapidly, right? We can see that the REOs, they're almost always going to sell. Why would they always sell? Well, the bank has to liquidate the property, right? However, the short sales, there's some variation in terms of when they sold, how many were listed, and the likelihood of sale here. And we're going to look at this a little bit more closely within the paper itself. But this highlights that relationship. So the first question we ask is, did securitization affect the method of liquidation? And we're going to run a linear probability model, just a kind of simple OLS setup here, hedonic regression, where the first thing we're going to test is in column 1 here, did the securitization type affect the likelihood that it's listed as a short sale? So we're just checking, if conditioning on default and liquidation, did they at least list it as a short sale? And we can see here that if it was a GSE securitization or a PLS securitization, it decreased the likelihood of listing by about 18 to 19%. So, it had a fairly large effect. Then in column 2, we're going to say, okay, conditioning on being listed, did securitization affect the probability that it actually sold? So we can see that the number of observations dropped, right? Because we're conditioning on it actually being listed. And if we jump back to the previous slide, we can see that here, not a lot of the short sales that actually were listed did not sell across the 4 cities. So we're particularly interested in this question. And we find that securitization, both GSE and PLS, had a much lower probability of actually selling, not only being listed, but if it was listed, much lower probability of actually selling as a short sale. And that tells us that if they didn't sell as a short sale, they actually foreclosed and sold it as an REO. So we can see a strong relationship here in terms of how the property was liquidated. We're then going to take the results here and say, okay, we see a strong relationship. Can we use this relationship to examine how this affected nearby default behavior, right? Okay, it's interesting that securitization predicted whether we'd have short sale REO, but if this doesn't affect, the real economy, then, it's interesting, but it's not a big deal. So we're going to look at, did servicers' liquidation decisions, short sale versus REO, affect nearby default behavior? So what we're going to do here is, this is going back to the Gupta 2019 framework, we're going to instrument, we're using a different instrument than Arpit's paper. He uses basically mortgage resets on adjustable rate mortgages. we're going to use that relationship that we identified in the previous question. We're basically going to say, if securitization predicts whether it be short sale or REO, we can use that as an instrument to then predict nearby default. And the basic idea here is that if I live next to my neighbor and they have an REO, then that will affect the likelihood of me defaulting. However, whether they have REO or short sale, it's not completely random, right? Right? It would be nice if we just, every time there was a liquidation, the bank just flipped a coin and then we had, a true random experiment here. So what we do is we say we need an instrument. So we're going to instrument for whether it's a short sale or REO based on securitization. And the idea here is that if my neighbor has a PLS securitized loan, that will predict whether they have REO or short sale, but it will not predict whether I default, right? I don't know if my neighbor has PLS loan, right? I probably don't even know if I have a PLS loan. So I certainly don't know if my neighbor has a PLS loan, and it shouldn't affect whether I default or not, but it does affect how their property is liquidated, which then affects whether I default. So we think we have a pretty strong instrument here. So we're instrumenting for how it's liquidated. We include that in these tenth of a mile radius clusters. And we find that, it does predict, or does, how the property is liquidated does affect subsequent default. We find that if the neighbor property was an REO instead of a short sale, it's going to increase the probability of surrounding neighbors default behavior by about 3 percentage points. And again, that's on a base of 4 percentage points. So we find a fairly strong effect here, right? This tells us that if there were more short sales, it would have reduced surrounding default, which would have stemmed this cascading wave of defaults that we see in the data. So question 3 here, and I know I'm running through these quick, but I want to make sure I get through. I think I can do it here. We'll see. Why did securitization affect nearby defaults? Well, we said earlier on, short sales appear to be a win-win for the homeowner and lender/investor, but not necessarily for the investor. And this is getting back at the agency issues that we discussed earlier. And maybe I spent a little bit too much time on that, but I think it's really an important point in terms of what are we looking at here? We're really, I think, truly unraveling or providing insight into an agency issue, principal agent issue. So we show that PLS servicers, they're not incentivized to pursue an REO because it reduces their fees. Or I'm sorry, PLS servicers are incentivized to pursue an REO, not a short sale, because REOs increase the amount of fees that they can charge, right? I'm PLS servicer, I want to do an REO because I can take over property management, insource all these vendor functions. However, I have no incentive to maximize the sales price. Any dollar lost hurts the investor, not me. I'm going to liquidate the property, I'm going to collect all my fees, and then pass it on to the investor. So not only am I getting I have no incentive to maximize the price. However, I have an incentive to maximize the fees that then further reduces the net proceeds to the investor. Now, GSEs are a little bit different. GSEs, they're pretty smart because they have credit risk. They're basically saying, once the foreclosure happens, we're going to take over the ownership of this property. So Fannie Mae and Freddie Mac, once the foreclosure happens, they say, they basically transfer from the servicer, they transfer it into their own system and they oversee the process. And why do they do this? Because they bear the credit risk, right? Every dollar lost comes off their balance sheet, not the investors. They've guaranteed those principal and interest payments to investors. So they have the credit risk. So we can see that the principal agent relationship, it varies whether it's GSE versus PLS. We're going to exploit this in our exploration of liquidation prices. So the first thing we're going to do here, this is a very standard, straightforward hedonic price model. So if you've read the real estate literature, we're going to include property characteristics, number of bedrooms, bathrooms, size, square feet. And then we're also going to include tracked by quarter year, fixed effects to control for house price changes over time within these neighborhoods. And then, in addition to all those controls, then we're going to look at short sale and REO prices. And very similar to the literature, we can see here that short sales sell for a lower discount, or they sell for a higher price than REOs, right? The discount is less for short sales versus REO. So that's very similar to the literature itself. But what we're going to do, we're doing something slightly different here, is we're going to also adjust for the condition and the quality of the property, because we suspect that with short sales, the condition and quality of the property is going to be better than REOs, because with a short sale, the homeowner is still living in the property and they're going to maintain it a little bit better when they live there, right? Not only are they living there, but they have an incentive to maintain it because they want to potentially sell the property as well. That way they don't have a foreclosure. So we're going to include the text from the remarks, and I'm going to jump through this just to save time, just to show you an example here. But here's an actual agent remark from the paper that shows, this is a bank-owned property, Freddie Mac first look initiative, and then it gives us some information about the property. But one thing it has in here is that this is a handyman special, right? What does that mean? That means that it probably needs some work, needs some repair. So we're going to tokenize these remarks and include them as controls, additional controls within the paper. And we find that once we include them as controls, it reduces the baseline estimate for short sales from 19.4% down to approximately, well, I haven't exponentiated these, but we'll just say ballpark, approximately 13%, right? We can see that adjusting for condition and quality is important when doing this. And same thing with the REO, we can see that the spread is actually much larger here. So we can see that the difference between a short sale and REO discount, it used to be, the difference was what, 7.6%. Now we've reduced it all the way down to 2.6%. And this tells us that REOs are generally in worse condition and quality relative to short sales. Then finally, the last thing we're going to do, and we're primarily interested here, is this interaction between REO and GSE and PLS. And we can see that GSE REOs, they sell for a premium, right? Let's just focus on the text controls here. They sell for a premium relative to the PLS. And this gets back to those incentives where GSEs have credit risk, they oversee the process. So they're going to sell the property for a higher price, whereas the PLS loans, they don't have the credit risk. So they have no incentive to maximize the sales price. So we see they sell for a discount here. And I'm gonna, this just goes back to the text analysis we've done. But in conclusion, I think we provide some strong results that show that securitization and the incentives of mortgage servicers affect how properties are liquidated. And these liquidation decisions, short sale versus REOs, from a policy perspective, have important implications because they affect nearby default, and that the GSEs, they have some policies in place that mitigate this principal agent problem at the REO stage. So they have some controls which definitely have a positive impact. And then finally, in conclusion, going back to the motivation for the paper, after doing this paper, initially I thought I was this master negotiator. I got this great deal negotiating with the PLS servicer, but in essence, it wasn't that I was a good negotiator. I think it was just that the PLS servicer did not have the right incentives to maximize the sales price. And that's kind of what our results are telling us when we interact the REO indicator with the PLS indicator in our price results here. So I know I kind of ran through the results a little bit quick there at the end, but I'm happy to answer any questions and take feedback. And thank you all for attending as well.
Thank you, Patrick. Aditya, would you like to speak your question now?
Yeah, I will.
Please introduce yourself.
I just wanted to, pardon me?
Please introduce yourself.
I am doing Master's in Economics, and I'm also interested in the domain of financial risk management. So I had a question. Okay. Given that you've discussed the liquidation risk associated with the REOs, I was wondering whether, if this goes into the calculations, of course, the value at risk and the credit value at risk and all the other things, increasing the cost of capital for the firm, and of course for the insurance premiums, and the demand for overcapitalization to satisfy the senior securities, then I wonder why RU liquidation is still a thing. Like, why not? Sort of, doesn't that dissuade the special purpose vehicles from going to the RU liquidations?
Yeah, that's a great question. We, drawing a direct line from the results to actual, is it being priced into subsequent mortgages? That's very difficult to do, but I think there's definitely some policy implications or pricing implications on, subsequent securitizations, right? Like, if anything, let's jump all the way back to the beginning. I would argue that potentially our results partially explain why, we saw the explosion of PLS, but it really hasn't come back within the market. And I think part of that reason is that there's certainly an agency issue here that hasn't been addressed. And until it's addressed, I think it's hard to price these, these issues into the actual securitization itself. So that could potentially explain why we haven't seen PLS come back into the market, at least in the United States, over time. But I think that's, big picture. I think those are the type of questions that would lead to additional studies or extensions of our work, but we have not explored them.
Debarpita?
Yeah. Thank you, Dr. Smith, for an extremely interesting paper and a presentation. My question was very simple. How is it that the PLS, in terms of credit risk, as you mentioned, that they don't have a credit risk versus GSE, which are basically government-backed mortgage-backed security companies, and PLS are private securitization companies, like in case of like excess real estate capital, in case of when you have bought the house. How is it, the structure is different?
Yeah, and that's a great question. And in some ways, because the structure is different, we kind of expect this to happen, right? So the GSEs, when you buy into a Fannie Mae or Freddie Mac securitization, you're basically buying, an individual share within that pool of mortgages. And Fannie Mae or Freddie Mac, they're taking on the credit risk, right? They're basically saying, we'll guarantee the principal and interest payments to the investor. And if there's any default, then we're going to have to pay them. So the primary risk for investors with the GSE securitizations is prepayment risk. They're not worried about default risk because Fannie Mae and Freddie Mac, they've guaranteed that. Now, on the PLS side, it's a little bit different. We have the investors, they're worried not only about prepayment risk, but also default risk in terms of the mortgages themselves. And, in hindsight, kind of piggybacking on the last question, I don't know if that was appropriately priced into the PLS securitizations when these investors bought the different tranches or slices that they invested in. But it's just kind of a institutional or foundational setup. It's just how the securitization market has worked in the United States at least. But I think this does have implications. The United States is somewhat unique in terms of the level of securitization of mortgages. So if this were to, if I were a country that was looking to potentially emulate or move more towards securitization, I think the results of this study provide a word of caution in terms of what type of securitizations you want to offer, or maybe should the government be involved in terms of the GSEs. I think, we don't necessarily talk about it in our paper, but I think that is something we should potentially think about and discuss in terms of the policy implications.
So just a small follow-on question. So generally then PLS...
Could we get back to you later on? We have some other questions as well. If we have time, we'll come back to your question. Vignesh. Mr. Vignesh, do you have a question? No? Ashish, Ashish Gupta.
Yeah, hi. Good evening and good morning to Dr. Patrick. I think it was a very interesting presentation you had. I have a small question which I just wanted to understand from your study or as per your understanding. Why do people normally default? Is it when they have negative equity in the project, or are there any other major reasons also why people normally default on their mortgages?
Yeah,
Yeah, thank you.
yeah, no, that's a great question. And, you know, unfortunately, time constraints, it's hard to discuss everything within the presentation, but, you know, I think within the literature, there's a terminology that's very common called the double trigger mechanism in terms of mortgage default. So sometimes just having negative equity is not enough to cause default. So the double trigger means that for you to default, you have to have some type of life event, whether it's you know, a family issue, divorce, or potentially you lose a source of income, unemployment or income curtailment. So it's that, like, you lose your source of income and you have negative equity, right? So that's the double trigger hypothesis. Because let's think about it this way: if I lose my job today, and let's say I own my house, but I have positive equity, I've built up equity, then I can just sell the house, right? I don't have to default. However, if I lose my job and I don't have enough equity to, you know, after selling the house to pay off my mortgage, then I could potentially default. So in a normal environment, normal housing environment, you know, you typically need that double trigger event. You need to have a loss of income or a life, you know, kind of family issue, and you need to have negative equity. Now, during the housing crisis, it was a little bit more unique because there's been some literature in finance that shows that there was some strategic default as well. So we didn't necessarily have the double trigger event. We had just negative equity. So homeowners were so far underwater that they just decided to walk away from the house, even if they could make their mortgage payment. So I would say, you know, there's two kind of hypotheses out there, and you know, there's usually typically two events that lead to default. But during the housing crisis, I think it was I don't want to say once in a lifetime. I hope it's a once in a lifetime event where we did have a lot of strategic default within you know, the residential market, at least in the United States.
Mm-hmm. Devarpita, please go ahead with your next question.
Yeah. Would I be wrong to assume that the PLS, when a PLS agency buys a loan from a lender, right? That agency usually buys it at a higher rate than a GSE agency, GSE servicer? Would it be generally the case?
That's a good question. So there are some differences in terms of the type of loans that are being purchased. Again, that I didn't necessarily talk about within this presentation. So I would say it would be difficult to say that they pay a higher price, just because, you know, Fannie Mae and Freddie Mac, they're buying what we typically refer to as conventional loans. So typically they have higher credit scores, you know, their debt to income ratio is a little bit lower, whereas PLS, they might be buying some of those subprime, you know, different type of, you know, no doc or low doc loans. So it's hard to compare the price of the two type of securitizations in terms of the purchase price of the loans. Because it's not really apples to apples, but that is a good question, and, you know, something we try to discuss within the paper.
Yeah, and I will piggyback on that because I have some feedback. These GSEs also securitize commercial mortgages, although very limited, mostly multifamily. And there they have a special provision called DUS, Delegated Underwriting Services. And if I remember correctly, there is some degree of selection bias in which loans will be securitized through the GSE channel and which loans through the PLS channel. Like there are conforming loans and non-conforming loans. I think that is where those definitions lie. So I was wondering that, and you do mention that the asset quality itself has a role to play, but could there be a selection bias at the asset level itself? So you do address those concerns post securitization, but you also discuss that these GSEs will try to uh, they will have some capex in the assets before they sell it. So I was wondering if you could control for the selection bias right in the beginning. So is it that the difference in the discounts across REO and short sale between PLS and GSE because of the agency problem of the servicer, or is it because the poor servicer only got certain types of assets through those conduits in the first place? So some kind of a propensity score or maybe a match sample mechanism, at least as a robustness test, just a food for thought.
Yeah, I think that's something we want to take a little bit more serious in future versions of the paper. Like this is a first version. One thing I would you know I would say in terms of you know our setup is, and I think this kind of works to our advantage when we're talking about loan modification, right? Like the previous literature, they're very worried about the borrower, right? Because they're trying to make a decision based on, should I modify this loan? And they're trying to figure out, well, if I modify it, will the borrower redefault or you know make payments until maturity? Now, our setting is a little bit different because we're conditioning on default. So we're saying, you know, the lender decides not to do a modification. They're going to liquidate the property. So once they decide to liquidate, the borrower doesn't matter as much, right? Because they're not going to be the one that's buying the house. So our argument is basically that we're more worried about the asset because that's what they're trying to liquidate. And the borrowers at that point, they're, for the most part, they're outside of that decision. So in some ways, you know, whether or not the borrower qualified for Fannie, a GSE versus a PLS doesn't have, I mean, I think there's some implications.
I agree. Yeah, you're right. I think the selection bias at least does not come from the borrower side, but there could be something about the asset quality itself, which could perhaps lead to this phenomenon, because this is kind of an econometric concern to some extent. That are we really measuring the agency problem of the servicer, or are we really measuring systematic difference across asset quality between two types of securitization? I don't know if
I think that's fair. Well, in terms of the choice of the liquidation channel, I would say, you know, I don't know if we're as worried about, well, I guess, you know, we are worried about the condition and quality of the property, right? Like if you have a property that's just in really bad condition, it might be hard to do a short sale versus an REO. And that's kind of why we use some of the text analysis to try and control for that.
Right.
Is it a perfect control? Not necessarily, but I think maybe what you're getting at, and you know, we've thought about it a little bit. We haven't figured out the perfect solution yet, but what we're probably worried about is once we do that IV regression, right? Like we have those 1/10 of a mile radiuses, like the probability, we're using PLS versus portfolio as an instrument. And should we be worried about PLSs being in certain types of neighborhoods, right? Like lower quality housing or versus, you know, portfolio loans? Did that factor into that decision? And we have a few ideas in terms of how to look at, you know, the spatial concentration, do some matching, things of that nature. But we haven't implemented them yet. But I think that's a very good point.
I think PLSs would also go for very big ticket homes as well, because I think GSEs would have an upper cap on the price of the asset that is being securitized, if I remember correctly. So I think it could go both ways, and I think that will only add to the explanatory power of the models. Not that I'm, you know, I haven't read the
No, that's a great point. So yeah, jumbo loans, you know, a common term in the US. You know, there's a cap in terms of GSEs. won't lend above a certain amount. So in those neighborhoods, yeah, that could work in our favor.
So I'm not distracted. I'm looking at some other questions. I'm just hoping that I'm not missing any good questions that we have. Devarpita, about loan modification. I guess that's a very long discussion for Dr. Smith to conduct today. Maybe we can have a chat offline, or you could write to him directly. It's a whole lecture that we used to teach at Atlanta, in Atlanta. I don't see any specific questions here. Maybe one minor comment, Dr. Smith, that do we need to be specific about the differentiation between servicer and the special servicer? Because this agency problem perhaps is stemming from the special servicer and not the servicer itself. I think it's more of a semantic observation than anything else.
Yeah, so I think at least in CMBS, commercial mortgage-backed securities, servicers, special servicer is definitely a huge consideration. My understanding, and I'm relying on one of my co-authors, Anurag Mehrotra, who's worked in banking, not only in the US, but internationally. He said it's less of a concern, and his dissertation was about servicing in residential. He said it's less of a concern within the residential space in terms of having that special servicer step in and their potential incentive alignment.
Okay,
but that's certainly within CMBS. That's a huge issue. But I would have to rely on his specialty there, and I can pose the question to him.
Sure. I think this is a very minor concern. I guess someone has raised hand, but I don't know how to identify the person. Please self-identify yourself in the chat window so that I can unmute you.
I think it was Arunashish Maiti.
Arunashish. So Arunashish, I'm unmuting you. Please go ahead. Arunashish? In the meanwhile, does anyone else have any questions or suggestions or feedback or comments? No? Well, then that perhaps is the end of today's webinar. We had a wonderful discussion. We had participants from all over the globe, including many Asian countries, Bangladesh as well. Thank you everyone for attending. Before we leave, we would like to announce that our next webinar will be on Tuesday, 29th June by Dr. Jean-Philippe Weisskopf from EHL Lausanne, Switzerland. And the topic is online reputation and debt capacity. So I hope you will join us again later. At this moment, I really thank Dr. Patrick Smith for such an engaging presentation and a wonderful paper. I wish you the best for the rest of the life that this paper has to traverse before it gets published, hopefully in AER.
Oh, I don't know about AER, but I hopefully top finance. I'll take any publication, but we'll shoot for the top and see. But thank everyone so much for one, showing up, and then also just the great questions, feedback. It's always good to, even if we had thought of a question before, it's always good to hear that same question. So we're on the right track. And even if we thought about it, maybe we haven't given it enough thought in terms of implementing it. So I'm gonna go back. I'll look at the all the questions in the chat and the Q&A and definitely incorporate them. So I really appreciate it. And also my email is patricksmith@stsu.edu. If you're interested in getting a copy, we hope to actually start distributing the paper in a couple months once we implement everything. But if you have any questions, comments, or like a copy of the paper, please do reach out. I really appreciate you showing up today so late in the night.
Well, thank you very much, everyone. See you in the next webinar. Have a wonderful evening and a wonderful day.